welcome to this interview series where we bring you face to face with the people who manage your money. Today, joining me and my colleague Chirag is Prateek Agrawal, MD and CEO at Motilal Oswal Asset Management Company. Welcome, sir.
Thank you.
Now, I'm curious, could you start by telling us what drew you to equity investing after you completed your BE in electronics?
No, so I did my BE and then MBA in finance. So you are really taking me back in time, and had a chance to look at the markets closely while I was in college. And just to tell you, while I was there, know, I did a report on several sectors. So these, I'm talking 93, 94, pre-internet days. So reading magazines, following newspapers, etc. Did a research report on several sectors, several companies, trying to showcase to potential recruiters, see, I'm interested in this field. So the interest goes back a very, very long time. And it continued in SBI Capital, which was my first job. The capital market division was the main sought after division there. When I was asked what I wanted, I said equity research. So the guy who was asking also was taken aback a bit, but that was it. So very interested in the field, very, very long journey. So ठीक है. It's a very high on learning and continuous learning kind of a field.
We spoke about the SBI research. And way back in 1994, you started there as a in the research team, and things were quite different. There were only only one exchange. There were FIIs were just starting to come in. There was demat account was not there. So over the period of time, if we look at it, how has the research evolved over the period of time, sir?
It's evolved and evolved. A lot of things we started. Earlier there would be research on one company. That itself would be a big thing to have. Printed reports. We were one of the first to bring out. Those days there was an ISEC who would do it. There was us. There would be one or two smaller brokers. But then bringing out, if there were 5 companies in a space, let's say autos, bringing out research on all of the companies in the same report was done, frankly, first time by us, similarly for steel and so on. So it is, in our line, it is not absolute knowledge which works, but comparisons also matter a hell of a lot. And when you bring out research on multiple names in the industry in the same report, that gets enabled, which otherwise it would not be. So I think now it is all at par. Every guy does this. Over time, from a period where everybody looked at just price earnings as the manner of evaluating two businesses, I think times have changed. People now understand there are other manners of evaluating businesses. It could be sum of parts, it could be DCF, it could be price to book, and so on. So that has definitely changed. And yes, in those times, I think internet itself came in 96, 97. Before that, there was no net. So access to information itself was very constrained. Now it is vastly more. Earlier, annual reports used to be much thinner, and people used to say, give us more transparency is better. Now it is on the other side. People are so transparent, or at least the annual reports are so fat that the analyst can just get lost in that report. So it is the other end of the spectrum today. One more thing I can tell you, in those days, every report that we would write, we would have a foreign comparison. So, Indian market, we knew, we were always confident we have a great growth story going forward. We are one of the fastest growing economies globally. And yet, our businesses would be like half the piece of businesses abroad. Data from US would be available, and every research report, ours or somebody else will compare with similar industry American company and say, oh, we are so cheap. Now that's no longer the case. So from a 8-10 P that used to be there for most of the companies versus 18-20, if not more, valuations for an American company, for example. Now I think the valuations look way similar, or we may be actually significantly higher than companies in the West. So the wheel has turned full circle.
You've had a long career serving as head of research and head of equity at different fund houses and a significant stint at ASK Investment Managers. Could you share with us what are some of the key lessons that have stayed with you throughout your journey?
Now, so you learn from every platform. So let me share with you some interactions which happened so that you and your listeners would understand uh, uh, the journey and how and what shaped me over a period of time. So, in ABN, which was my job after uh, SBI Capital. So I spent 10 years in SBI Capital and then moved to ABN AMRO as a startup. So that was a startup mutual fund. So we were two people, and when my boss, Mir, who had hired me, moved over to HSBC, I became head of equity. We had a very good performance there. Funds were looking good, etc. And ABN, being a global house, thought of doing a India fund. So in early 2000s, every foreign house was launching an India fund. And a sales guy from Amsterdam came, and I was made to speak to him. And how do you try and communicate what you are doing? So we speak sectors, we speak stocks, etc., etc., valuations, trying to make the sales guy from Amsterdam who may be coming into the country for the first time as to how we are doing it. Okay, and at the end of the conversation, he says, "Very good. If your performance sells, I can sell you, or else I will have to put you in front of the client." So this is 2006 kind of a period. Had never been or had been only to Hong Kong kind of a place before out of the country. And if a guy says, I will have to put you in front of the client, I assumed it would be Europe, US kind of clients, and I was happy. Yeah, very good. Now, slowly, the depth of what he was saying occurred to me, which is, if you have to be put in front of a client, then there is so much of scalability that you will have. You know, for much better scalability, sales should be able to talk about what is being done, what is or how are we thinking to the client. It should be so simple, and that will allow for much bigger multiplication. So that is one thought, and when I come to ASK, we will talk of that. In AXA, which was my next platform, again a startup. Here the team was built around me. Uh, we launched, we got hit by Lehman. Lehman happened bang in the middle of the launch. So in those days, launch period was 1 month. Uh, The lesson in AXA was, so ABN was house number 13, 14. It was MNC house number 3 or 4, if I remember right. AXA was house number 43. Okay, all over 3.5 years. Now, so if you Google out, you will still find ABN AMRO launches. The first fund launch was a record. The second fund was a record. It's a series of records. Okay? And you feel that the market needs you. You are being welcomed in the marketplace. At house number 43 with a brand like Bharti AXA, what we were told, even ex of Lehman is, well, yeah, good brand. Put yourself on the shelf. If there is need, we shall sell. Okay, so house number 43, you understood this is a commodity kind of a place. So that is the second thing. Now, in AXA, if you were there around Lehman times, well, AXA as an organization escaped Lehman by and large. Very, very strong on risk controls and all of that. And the guys there would come. AXA world number 2 was a risk guy. And he would come down, try and explain things, or at least making sure that we were not indulging into those things. So I remember a conversation when he says, I hope you guys are not doing anything on OTC, options, futures, etc. Now, what is OTC? So here everything happened on exchanges only. You will get to know. So, well, he got assured, we don't know, we won't go there. It doesn't exist in this country. And then everything unfolded. So, and the learning was how these guys think about risk. Well in advance, be prepared. Not everything would be right. To understand when the music would stop is a big thing in our markets. If you get off it way before time, well, you lose performance. If you are stuck with it till the end, well, you again lose performance. Now, there is another thing which happened in AXA. So you started with my background in SBI Capital. So SBI Capital was a State Bank of India subsidiary. State Bank of India is a PSU. And before that, my life has been PSU. So I am a product of Steel Authority of India. Brought up at least in a steel township. Now, when you have an upbringing like mine, you believe governments, public sectors build the nation. Okay, so in AXA, the big jolt that happened was this is $1 trillion house. Okay, and they reported buying $150 million franchise. Although $1 trillion house buying a few $1 billion, $100 billion is par for course. It would not, get me interested. But $1 trillion guy buying $150 million franchise, I'm wondering, why did they do it? And I spent time there. So they had acquired, let's say, a franchise where the manager was focused on entrepreneurs. A guy called Charles. And we had a conversation, and he impressed on me that while governments may do policy and all of that, it is the private individual, it is the promoter, entrepreneur, whatever you may want to call him, the guy who is taking risk and shaping up his future, and along with it, the country's future. It's just that in India, we are blessed with so many entrepreneurs that we don't appreciate this. But globally, where Most of the businesses are now run professionally. They appreciate this hell of a lot. So that was one big thought that got implanted. And then when I joined ASK Group, which was the next one, and where you asked, it was 11 and a half years journey. When I joined, it was 1,200 crore of AUM. There was a fund called Entrepreneur Fund. Where this was something which just fitted into something which I learned in my previous role. So in a new organization, you want to seek familiarity in products and what you do. This was one product which was familiar. I knew of the global thought processes, that this is something which is very scalable, etc., etc. This product of the 1,200, 1,300 crore AUM was just about 80 crores. Now, the other good thing about this was it was very disciplined. So, Bharat and team there had formulated filters, etc., and which made sure the managers managed the fund in exactly the same manner. Now, if I tell you, put two and two together, this problem of style purity, that a sales guy can sell, and that was my learning in ABN. Got satisfied here. You manage funds with one style towards one objective over long periods of time. If the philosophy is good, if the style is good, hopefully results follow and it can become a very large franchise. That happened, and an 80 crore fund became the largest in the industry by a long mile. When I left, it was a 28,000 crore single fund. The house had a 38,000 crore overall AUM. So, I just try to put some stories so that you understand what is it that is valuable, why we do a few things, and this understanding that, it is money. Money is something that, you wouldn't give to your relative. You are otherwise very, very emotionally connected with them, right? If you give it to them, you would still want to remember how much you gave, etc. And when we manage money, we should understand what is it that somebody is entrusting us with. Uh, uh, Entrust has trust. So it is very deep. You have to make use of all the money, invest it in the best possible manner to your mind, make all parts of the money work, not experiment with somebody else's money, and so on and so forth. And the journey for the investor should be as smooth as possible. So this was again something which over a period of time just got embedded. Managing money can bring with it several conflicts. Well, one has to remember the trust that somebody who is giving money to you is putting into you, and you should never break that trust. If you break that trust, you shall never grow large. So those are the various things in terms of style. Well, been always growth focused investor. So I said when I started out in '94, everything in India was cheaper than what was there globally. So happily, you could call it GARP. That continued till, let's say, mid 2004-5 kind of a period. After that, that RP, reasonable price in GARP, is extremely tough to find. Happily, if the focus has been growth, growth continues to be strong, getting stronger. So 8 to 21 was a very weak period of earnings growth. Now, 20 onwards, getting stronger. We say this is a period unlike any other in the past. And I think we are very well positioned as investors who seek high growth in earnings.
Sir, you have been in the markets for the past 3 decades, and markets have seen significant changes as we discussed earlier. What are the key significant changes, according to you, which have taken place in the market over the period of time?
So volumes for one, earlier part of 2000, volumes were a big issue. Depth in the market was not there. Uh, Now that has changed. Depth in the market for funds of the size that used to be there in 2005-6 kind of a period was also not there. I think that has changed a hell of a lot. I think the policymakers have really worked towards that. So, getting in pension monies into the larger cap part of the market, getting in insurance monies into the larger cap part of the market helped stabilize that part of the market and enables us to absorb a lot of selling if it happens, like it happened during COVID times. From the bottom of COVID, for some reason, the mid and the small caps have seen consistent inflows from retail investors through SIPs, which has given this space a kind of strength which never existed before. So that has definitely happened. And yes, the expansion in market caps. Earlier, what used to be, where the large caps used to start from, early 20,000 crores in early 2000s, is where is in the small cap territory now. So expansion in market caps have definitely happened. And three, the quality of businesses which are there in the market. So the companies used to, so 2000 to 2008, for example, were the house of debt. The one big difference that you see now after all of what has happened in the interim is companies are repaying debt. Debt equities of India Inc. Are looking very good versus historic. So and corporate governance. So earlier companies which could come in, raise money, evaporate were just too many, and I think over time the regulator put a lot of spotlight there. Rules became stringent, and now the kind of companies that you have are much better. Many of them are PE backed. So earlier, maybe banks and capital markets used to behave like private equity, give money to very young small businesses. Now other entities take that risk, so that what has happened is going has become much safer, much steadier for smaller investors in general. And of course, over time, democratization of the market. So, and in this manner, Indian market is like probably none others. Here, in every other market, iBankers are a very powerful breed of people. They will make a deal available to you if they like you, kind of stuff. So every manager would want to warm up to them. India is a very different market. The IPO process, for example, is completely democratized. The flow of information here is completely democratized. Everything that a corporate speaks to a manager in any interaction is also put on the website, and a small retail investor can also download it, see it. The earnings call are now open to everybody. Anybody can come in and listen to them. The text are available. You can read through them. Earlier, results used to be annual, then they became half yearly, and now they are quarterly. So all of that journey has happened, and I think for the better. Now, in many ways, our markets are some of the leading markets in many respects in the world.
Working with Bharat Shah at ASK Investment Managers, it must have been an enriching experience. Can you share with us how this collaboration influenced your career?
Okay, so let me put it this way. One big risk that any fund management platform has is the manager risk. Okay, in ASK, we attempted to have a team-based decision making, and we thought we were very successful in that, in the context of the results which were thrown out over a period of 2011 to September 22. I lost track after that. I would say that in ASK, well, the meetings were very intense. Everybody challenged everybody else. And what happened was the outcomes were better than what otherwise would have happened if one guy was doing all the decision making. So that is something, and I think in the newer organization, we are also encouraging a lot of team-based processes with some tweaks. It is not like what an ASK does. It is more right for the organization that I am on. But yes, definitely, cross-pollination of ideas, talking on ideas to everybody, competing. And when you compete, I tell you an idea. Now, the other guy is also a very proud manager. He understands as a part of conversation what is working, what is not working, what are the attributes to look for, and he suggests another one. Now, that another one will be better than the first one because the other guy has the benefit of the first name. And in that manner, the names on the table just improve in quality and chances of working in the marketplace. So that is what it is, which is what we did. And the other thing was, in our business, people unnecessarily involve their egos with a stock, with a name. Okay. Now there, and I have to give it to Bharat. The egos went out. It was dispassionate uh, discussion on numbers, logic, valuations, which we had all agreed is how the market should eventually see a particular name. And the outcomes were based on numbers. So, also gone are the days when an investor bought a manager. If I ask you who are the 10 managers, big managers in the country, you being in the industry would not be able to recount. Okay, while people would say, yeah, in HDFC, Kotak, hopefully Moti are the houses that they are entrusting money with. So it is the house they are entrusting money, not the managers. Manager after the first four have all become commoditized. So if it is the house that people are entrusting money, then how do you bring the house and its belief to the end investor? The manager can't be a gatekeeper. And I just proved to you that if a manager is a gatekeeper, then the results are suboptimal. While if managers speak to each other, cross-pollinate ideas, compete with each other inside the house, the level of everybody moves up and the outcomes for the end investor is vastly better.
You spoke about your strategy, but can you just explain it elaborately? What is your investment strategy and what kind or the situations of market do you really like to invest?
So like I said, we are growth investors. Okay, today if you see, our portfolios are some of the highest growth in EPS portfolios in the country. And our products are focused, high conviction, and we say very premium products. I made a point that the client, when he sees our products, should not feel that his monies are not being taken care of adequately. And so if you see our product, there is no littering. There is no position like a 0.25%, 0.5% kind of position. Every position is over 2%. Every position is below 7.5%, 8%. At the time of buying, unless, of course, pricing can change it, but that is how it is. When you hold our product, it speaks growth. And we try for sustained performance by including all the growth themes which are there in the marketplace. Okay, so if electric vehicles work, something should be in. If defense works, something should be there. If capex works, something should be there. If renewable works, something should be there. Luxury consumption works, something should be there. If fast growing banks work. So first, find out as a team, what are the spaces where growth quotient would be significantly higher than the index, because we as growth investors seek to make our alpha from the delta of earnings growth between our portfolio construct and the index. The higher the delta, the better are the chances of alpha after correcting for valuation differences, if any, is the whole thought. So once you understand that, the way the house functions is to chisel out very sharply defined themes. Some of them I recounted, China plus one being another. And then the managers pick some of the names with higher growth quotient where valuations make sense, is how we go about it. So QGLP is the philosophy we follow. Quality, quantum of growth, longevity of growth, and valuations. What we have tried to do is to convert the philosophy into a process and translate it into portfolios, starting with longevity. So that is a team-based process where we think themes very narrowly defined. Once themes are decided, then the managers pick some of the highest growth quotient names where valuations make sense to them. So GLP is decided. Quality, we want to make sure that cash on book or cash generated from business should be good enough to fund 3 to 5 years of non-dilutive EPS growth, up to an extent of 25%. So this is the construct that we have. If you look at the themes that we spoke about and look at our portfolios, you will find practically all portfolios to be adhering to all, if not all, most themes, which is how what you have seen is, fund after fund of ours, starting with the mid-cap fund, followed by LMC, have come up strongly over the past 1 year. We believe our performance got coincided with the peaking of interest rate, and believe hence that when they start to move down, our growth style of investing would get further tailwinded. We say this is the time when probably the investors should have style specialists. We see ourselves best in high quality growth investing. And I gave you the process of how we go about doing it. All of our funds, be it alternates, be it mutual funds, are between 20 and 30 stocks. Even our small cap fund is 35. Now, if you take two of our managers with reputation, typically on the high quality growth side, which is us, you will get 40 odd names. We say pair us with the two best guys on the value side. Now, those guys run longer portfolios, but let's say if you take two with overlaps, knocking off overlaps, you will get 110 names. You pair us, we hit around 150 names. competing with an index of 500. I think there is still a good chance of alpha.
So moving on, it's been a few months since you took over at Motilal Oswal Mutual Fund. What changes are you implementing in the equity portfolios there?
No. So changes in the equity portfolio, if any, has to be done by the CIO. I am the MD and CEO.
Hmm.
But yes, we set a lot of processes. I spoke to you about them. I think the team has really taken those processes to heart. You take any of our funds, and you will see teamwork at play. Many of our large success stories will find presence in more than one fund. It gives you a sense that members are a team. You will find profit-taking processes at work. You will find stop-loss processes at work. On value research, if you just spread our portfolios over 12 months and see what we have trimmed, you would have seen, something does very well and moves up on the percentage allocation. We want to rebalance. So versus earlier, we now run very flat portfolios across the house, mutual funds and alternates. Concentration levels at the top have reduced. In one or two funds, they still exist, but they are also coming down. That discipline about having all themes represented in the portfolio. So I named, I think, practically all themes. Try and see if these stocks fit in. You should see most, except the extreme market cap guys, the large cap and the small cap. So in a space, if a theme is not there, then that constrains a manager, but otherwise it's all there. And then try and see how many stocks out of the portfolio that we run participated in the market and did better than the market over 1 month, 3 months, 6 months, 9 months. Okay, and compete with competition. If you think our numbers look better, then it is because we put focus there. Stop losses are one thing, but even if there is something जिसको कहते हैं जो सड़ रहा है, neither going up nor going down, we want to keep the end result is we want to keep as much of the portfolio working for the client rather than languishing.
Sir, if we look at the overall history of the Motilal Oswal Mutual Fund, sir, since it started operation in around 2009-10, sir, it started with the launch of the passive funds. Then later on, the fund houses moved toward active funds. So, could you just explain to us what will be the strategy evolving going forward? Would you like to be an active player, passive player, or a blend of both?
So, we are a fund that is very equity focused. We do practically nothing on the debt side. Whatever debt we do is to facilitate people coming on the equity side, OSTP and SIPs. Okay? On equity, we want to do everything. So be it alternates, where we have very high on growth focused products, be it mutual funds. So all market caps with the multi-cap we would have covered. Contra, etc. is still there. Thematics are left. I think in a few months you should see thematics being launched by the house. And passives. So we are the leaders in passive. Close to 20,000 crores of AUM. We have products like NASDAQ. We're very successful. We have Nifty. We have 500. Now we are also bringing out bond strategies. So first, think equity. We want to do everything in equity. Cater to every client need in equity. So passives, actives, alternates on both the platforms, PMS, AIF is par for course. We do everything. Yes, on the active side for alpha over sustained long period, we are very high quality growth focused house. So if a investor wants to see alignment of interest, we are a house that just does equity. On the active side, it is high quality, high growth, but yes, passive side is more quant driven and index driven. Even on the passive side, the quants are high quality growth strategies. And then in terms of alignment of interest, well, this is one house which puts all of its treasury surpluses into its own products, either on the private equity side or into our mutual funds and alternates. So as we speak, more than 6,500 crores, closer to 7,000 crores of house money has been invested into our products. So if we are close to 80,000 crores of total AUM, 20 or 1,000 crores would be passive, rest of it is active. Of that, so 60,000 crores, of 60,000 crores, close to 7,000 crores is house owned money. So the alignment of interest with the small unit holder is as complete as it can be on this platform. The more I look at this platform, the more I say, there is no platform like this in the country.
Right now, bringing the focus to Motilal Oswal Flexicap Fund, which is your flagship fund. Could you share what specific changes have you guys implemented to enhance its performance so significantly in the recent past?
No, so last 1 year has been nice to us, and like I said, one fund after the other, all funds came up. On your this thing, if you see, after I joined, the first fund that came up was the mid cap fund. Flexi for some time had a setback, but now over the past 1 year, Flexi. And so mid cap fund followed by large and mid cap fund followed by ELSS followed by Flexi have all come up strongly over last 1 year. What we did, like I told you in the beginning, was to up one, be present in all themes, themes fleshed out with the team sitting together. Okay, upping the growth quotient of the portfolios. So when you see the portfolio and you think themes, one should expect to see some of the best representative of the themes in the portfolio. So that, when the time of that theme comes in the market, that part of the portfolio should do very well. And yes, keeping a very close eye on liquidity. So to our mind, at our sizes, we think we are very liquid. Any fund not more than 7-8% is in the less than 10,000 crore category, market cap category. For a flexi, that number, if I remember right, is 2-3%. Okay, so in terms of liquidity, stress testing, it scores very high. So that is what we did. We upped the growth quotient across the house. So, if you look at our house, you will find practically zero large cap IT, where the growth quotient is less than the index, right? You will find practically zero larger cap banks, where once again the growth is tending to be closer to the index, while valuations are they're coming down, but they have still not come down to levels we like. Third, we don't have any cement, for example, any space, no staples, any space where the earnings growth is expected to be lower than that of the index, we don't have. We want earnings growth delta of, let's say, 3+% over the index over 3 to 5 years, so that even after paying fees, there is some alpha left for the client. So you see our portfolios, it's very high on growth portfolios, and we could design them because we recognize, like I shared before, that over the past 3-4 years, there have been several new spaces which have emerged for investing in the secondary markets. High quality spaces, low on debt, actually cash on book kind of spaces with very long runway of growth. Mostly aligned with the policy making environment in the country. in line with the global aspirations of a cleaner planet, for example.
Sir, how do you deal with disagreements with the fund managers over some investment decisions?
No, no. Our job is to set processes. We in our house give a lot of freedom to the managers. We control through fleshing out themes which any which way the managers two sitting together or the CIO leads. Okay, then the control comes in by looking at the performances. There are processes for what kind of underperformance is tolerated for what period of time and so on, and corrective actions taken. See, if I have had a research and a fund management background, it helps to understand how the fund manager is thinking. And the whole approach is to empower him to take the right decision. So we understand that in our line, in our business, in our profession, mistakes will happen. Okay, it is not good, for example, to perpetuate the mistakes. It is best to recognize the mistakes, okay, and correct the portfolio so that the monies can be put back into work. So I shared with you processes like stop loss. We don't criminalize stop losses. There is no, we understand it happens. We say, good, you have recognized that something wrong is happening to a place you're not able to understand. So yeah, I mean, the stock may move up from tomorrow, but was you were not understanding it, we at the house were not understanding it. So take courage and move. And then there is a overall guiding force of philosophy of UGLP, which says longevity, it says quantum of growth. So very simple 100, 125, 160, 200, 250 kind of EPS earnings growth. If it happens, both good in quantum and longevity, chances of the market recognizing it is high. Now, why would disagreement happen? Is in the disconnect between longevity of growth, is in the quantum of growth in the immediate this thing, right? Valuations, any which way, every guy has a different lens. Now, the manager's decision is final. You can only share your thoughts. Outcomes the market will have. Control function comes in after outcomes happen. So that is how it is. Once you look at our portfolios, you will see teamwork. It is not about me, the house, bringing a manager to the client. We are trying to bring the house to a client. इसमें फर्क है. If we don't like people who are not team players, people who say me, mine, it is not your money. Client monies. Client has not given to you. Client has given it to the house. House has a fiduciary responsibility to have a good, sane manager who allows the thought of the house to come into the portfolio, for better outcomes. So, our managers, we believe, are a level evolved. ये me, my happens because of insecurities. Our managers are over that, is what I believe.
All right, sir. Now, with all your experience, what's the most surprising market trend or event that you've seen? And how has it shaped your investment approach or philosophy over the years?
No, so lots happen, but I do remember one conversation few days before Lehman, okay, with the head of research of Lehman in JW Marriott, yeah. And he says, just believe in one thing, if valuations are good, the market will find its level, don't worry. So that happened, Lehman happened, market cracked big time. But soon enough, for for an event like that, while valuations manifested themselves, it came back. So really believe in that. No amount of uh, anything else can work for a sustained period of time. In the end, it is numbers. In the end, it is valuations.
Right. So with that, it's time now for us to wrap up this chat. Thank you, sir, for taking the
Thank
time
you
for this
so much.
interaction.
Thank you.